For decades, boardrooms operated on a simple assumption: the future could be forecast with reasonable accuracy. Executives built plans around a central outlook, adjusted annually, and measured success by how closely results matched projections. In 2026, that assumption has collapsed. The future now arrives in fragments, shocks, and sudden reversals. That is why scenario planning has moved from a niche strategic exercise to a core boardroom priority across U.S. companies. Scenario planning is not about predicting exactly what will happen. It is about preparing for multiple plausible futures at the same time. Instead of betting everything on a single forecast, companies explore a range of outcomes and design strategies that can survive across them. What once felt academic or optional has become essential as uncertainty has become structural rather than cyclical. The first driver behind this shift is the breakdown of traditional forecasting. Economic indicators, consumer behavior, interest rates, and geopolitical conditions now change faster than planning cycles. Forecasts that look solid in January can be obsolete by June. Boards have learned that relying on a single outlook creates false confidence and leaves companies exposed when conditions shift suddenly. Recent years have reinforced this lesson repeatedly. Supply chains broke without warning. Demand patterns flipped. Financing costs changed faster than expected. Regulatory environments shifted mid-cycle. Companies that planned for one outcome were forced into reactive mode. Those that had considered multiple scenarios moved faster and with less damage. That contrast has not been forgotten at the board level. Capital allocation is one reason scenario planning has become so important. Decisions about investments, acquisitions, hiring, and infrastructure now carry higher risk. A project that works well in a growth scenario may fail badly in a slowdown. Scenario planning allows boards to test decisions against different environments before committing capital. The question is no longer, will this work, but when does this work and when does it fail? Interest rates have amplified this need. When capital was cheap, mistakes were survivable. Today, financing costs magnify errors. Boards want to understand how strategies perform under different cost of capital assumptions. Scenario planning helps identify which initiatives are resilient and which are fragile. That insight directly influences approval decisions. Risk management has also evolved. Traditional risk frameworks often focused on isolated threats. Scenario planning looks at how risks interact. A supply disruption combined with regulatory change and demand softness creates very different outcomes than any single factor alone. Boards now want to see how compound risks affect the business, not just individual hazards. Another reason scenario planning has gained prominence is investor scrutiny. Shareholders are less forgiving of surprises. They expect leadership to anticipate volatility and communicate preparedness. Boards use scenario planning to pressure test management assumptions and ensure narratives are grounded in reality. This strengthens credibility with investors and reduces the chance of being caught off guard. Scenario planning has also changed how boards think about strategy itself. Instead of asking management to present a single, best plan, boards increasingly ask for optionality. Which decisions can be reversed? Which commitments are flexible? Which bets lock the company into one future? Scenario planning highlights where flexibility exists and where it doesn't, guiding more resilient strategic choices. Operational planning has followed the same pattern. Workforce decisions, supply chain design, and pricing strategies are now evaluated across scenarios. Boards want to know how quickly costs can be adjusted, how suppliers respond under stress, and how customers behave under different economic conditions. Scenario planning exposes operational weaknesses before they become crises. Technology and AI investments have further pushed scenario planning into the spotlight. These investments are expensive, long-term, and often irreversible. Boards need to understand how returns change if adoption is slower, regulation is tighter, or competition intensifies. Scenario planning prevents overcommitting to optimistic assumptions and encourages phased investment instead. Regulatory uncertainty plays a role as well. Rules around data, AI, labor, and environmental standards are evolving. Scenario planning allows boards to explore how different regulatory paths affect profitability and compliance costs. This helps companies avoid strategies that only work under narrow regulatory conditions. There is also a governance dimension. Boards are increasingly held accountable for oversight failures. Scenario planning provides a documented process, showing that risks were considered and alternatives evaluated. This is not just strategic prudence, it is a form of governance protection in an environment where hindsight scrutiny is intense. Importantly, scenario planning does not slow decision-making when done well. It speeds it up. When uncertainty hits, companies that have already explored scenarios can act decisively. Boards are not debating fundamentals under pressure. They are executing pre-considered responses. Preparation replaces panic. This shift has changed the role of the board itself. Directors are spending less time reacting to quarterly results and more time discussing resilience, downside protection, and adaptability. Scenario planning provides a structured way to have those conversations without drifting into abstract speculation. In 2026, scenario planning is no longer about predicting black swans. It is about accepting that volatility is normal. The goal is not to guess the future correctly, but to avoid being surprised by it. Boards that embrace scenario planning are signaling a new definition of leadership, one that values preparedness over certainty. Why scenario planning is becoming a boardroom priority comes down to one reality. In today's business environment, the most dangerous assumption is that the future will behave like the past. Scenario planning replaces that assumption with readiness. And in an era defined by rapid change, readiness has become one of the most valuable strategic assets a company can have.